Hello students, in this video we will discuss Chapter 2, Tax Compliance, the IRS, and Tax Authorities. In this chapter, there are a total of 7 learning objectives, and we will break them down into a series of videos so that the length of each video will not be a burden for the viewing of students. Here are our learning objectives. What are the filing requirements for income tax returns and the statute of limitations for assessment by the IRS? Number 2, what are the IRS audit process and the aftermath of an IRS audit? Number 3, what are the relative weight of various tax law sources? Number 4, what is the legislative process of taxation? Number 5, what are the basic steps in tax research when faced with ambiguous statutes? Number 6, what are the tax professionals' responsibilities in tax advising? And number 7, what are the penalties for taxpayers and tax practitioners regarding tax compliance? We would like to start with learning objective 1, taxpayer filing requirements. The filing requirement depends on the taxpayer's filing status. Whether it will be, for example, corporations all must file regardless of taxable income. Estate and trusts required to file if gross income exceeds 600. Individuals filing is determined by taxpayers' filing status, age, and gross income. Here are some of the different filing status and age for individual taxpayers. And just keep in mind, this is a 2013 guideline. And whichever year you may be viewing this video, you may want to refer to the most recent video or go to the IRS for a updated information. So for this one, you can also find it in your textbook on page 2-2. Tax returns must be filed if taxpayers want to receive the refund they entitle, which means even though if you do not owe any taxes, if you don't file any tax return, then the IRS will not voluntarily provide you with a refund that you're entitled to. Tax return due dates. Generally speaking, for individuals, it will be the 15th day of 4th month following the end of the tax year. Generally speaking, it will fall under April 15th. Because most individual taxpayers will assume they are on the calendar tax year. And for corporations, it will be the 15th day of the 3rd month following the end of the tax year. So generally speaking, it will be March 15th. And if due dates are on a Saturday, Sunday, or holiday, then there will be extended to the next business day. For example, if April 15th is a Saturday, then the due date won't be April 17th. Unless April 17th is a holiday, then it will be April 18th. An individual corporation are allowed to apply for an automatic 6 months extensions, which means the individual filing tax deadline will be October 15th, and for the corporation will be September 15th. Here are some of the return due date examples. Corporation XYZ has a tax year which ends on August 31st. When will their tax return be due? November 15th. Okay, so we count from the year end will be August 31st. So we count September, October, and November. So it will be November 15th. Assume they file an extension. When will the tax return be due? Then there will be May 15th. So 6 months after the initial deadline. What about the statute of limitations regarding compliance, tax compliance? Statute of limitation defines the period in which the taxpayer can file an amended return or the IRS can assess a tax deficiency for a specific tax year. The statute of limitations generally ends 3 years from the later of 1. The date of the return was actually filed, or 2, the tax return's original due date. For this one, you may want to see example 2-1 on page 2-4. Bill and Mercedes filed their 2009 federal tax return on September 6, 2010, after receiving an automatic extension to file their return by October 15, 2010. When does their statute of limitation end for their 2009 tax return? So the later of the two, either the day of tax return was actually filed, or 2, the tax return's original due date. So September 6, 2013, 3 years after the later of the actual filing day and the original due date. So we compare the actual filing and the original due date. So later one, the statute of limitation will run out, which means the taxpayers cannot claim any refunds, and the IRS cannot go after them for any amount owed to the IRS. What about the IRS audit selection? Most people would like to know how they conducted this. Generally speaking, a taxpayer's return is selected for audit because IRS believe the tax return has a high probability of being incorrect. Being incorrect, which means we want to audit those returns that will give the IRS the most tax revenues. So IRS will use computer program to identify tax returns which might have a understated liability. For example, they will use DIF, or discriminant function system. This is a scoring system, and they never disclose how the system is it's created. They probably ask some people to create some kind of regression or the algorithm to identify some risk factors, or to identify high risk individuals for audit. Also, the document perfection system, they will the system will actually check for any mathematical errors that taxpayer may has input. For example, you're supposed to have income of 150,000, but you put in 105,000. So those could be mathematical error. Information matching system. Usually, when you receive your paycheck, part of that will be reported. What kind of withholding, what kind of income you have received will be reported. So once you return that, they will be checked and verify whether the information being reported by your employers that have been truthfully and completely reported on the tax return by taxpayers. So there are also different types of audits. First one will be the correspondence examinations. This is the most common type of audit. They are usually limited to 1 or maybe 2, up to 2 items on the taxpayer's return. The IRS generally just require some kind of document for the items in question, either the 1 or 2 items. For the next one, it will be an office examination. This is the second most common audit conducted by IRS local office. The taxpayer receives a notice that identifies the items, not just 1 or 2, but items in question. The IRS requests substantiation, which means supporting documents for those items with the date, time, and location of the examination, which means they need to go into the local office and show these supporting documents. Or it can come to the field examinations, the least common type of examination that will be conducted at the taxpayer's business premises, or where the books, records, and source documents are maintained. The items in questions are generally broadest and most complex. These audits can last for months, even years, and are generally limited to business or the most complex or some of the most high net worth or rich individuals' returns. What about the appeal process? Before we go into the appeal process, we want to keep in mind that the audit, people when they get audited, they usually get angry, but you really need to encourage your clients to go through the process and just take care of it, because if you ignore them, the IRS can still come after you. Just because you ignore them doesn't mean that the problem will go away. So we would like to talk about after the audit. The IRS agent will provide a list of proposed adjustments to the audited taxpayers for review. If the taxpayer agrees to the proposed adjustment, then the taxpayer signs an agreement on Form A70 and either pays the additional tax or receive a refund. So it could work both ways. Number two, if taxpayer disagrees or disputes with the IRS proposed adjustment, the IRS sends the taxpayer a 30-day letter allowing the taxpayer to either one, request a conference with an independent appeal officer in a separate IRS division from the auditing agent, or agree to the proposed adjustment. Number three, if taxpayer does not request an appeal conference with the IRS and still disputes the proposed adjustment, which means they ignore that 30-day letter, the IRS will send the taxpayer a 90-day letter or a statutory notice of deficiency, explaining that the taxpayer has 90 days to either A, pay the proposed deficiency, or B, file a petition in the U.S. tax court to hear the case. So there are some of the various tax courts, and we already mentioned about the U.S. tax court that can settle disputes between taxpayer and the IRS. Tax court, U.S. tax court is a national tax court, and the judges are tax experts. This is preferable because the taxpayers do not need to pay tax first before going into litigation. Another one will be the U.S. District Court or the U.S. Court of Federal Claims, are local courts where taxpayer must pay the deficiency first, request a refund from the IRS, sues the IRS for taxpayers must sues the if there's some kind of dispute, they must sue the IRS and claim the refund, which means pay and then sue the IRS, claim the refund. So these are some of the tax courts. Here is a exhibit of federal judicial system. So for your reference, that the highest court will still be the U.S. Supreme Court, even though as they do not include any may not or do not include any tax experts as one of the justices. So also the U.S. Also got separate into different circuit courts. So after the trial court ruling, the losing party has a right to appeal to the verdict at one of the 13 U.S. Circuit Courts of Appeal. For example, California is in the Circuit Court 9 or the Ninth Circuit, and the Texas, Louisiana, Mississippi, they all subject to the Fifth Circuit. All U.S. Court of Federal Claim verdict must be appealed at the U.S. Circuit Court of Appeal, a federal circuit court. So what about the tax? What about some of the tax laws sources? For this one, we will leave it for the next video. Now we conclude with our learning objectives 1 and 2 of chapter 2. For those of you who have questions, please make sure that you post your question online, or you can send me an email. I'll be answer your question according to the question you pose. Thank you.